The contents of this podcast does not constitute financial advice. Please do not take any financial decisions based solely on the information that you hear on this podcast. Please take advice from a professional financial advisor. If you do not have a financial advisor, reach out and we can assist you. I am a fit and proper financial advisor in South Africa. You can mail me at Yolanda at financiallyfabulousfemales.com. Everybody wants to be a property mogul these days. However, very few people have a strategy to get started. So today on the show, I'm giving you 2 entry-level property investment strategies that you can use to bolster your career as a property investor.
Welcome to the Wealth Nation podcast, a podcast for every mother, daughter, grandmother, sister, and wife, and the men who are smart enough to tune in. The Wealth Nation podcast brings you all you need to know about investments, business, property investments, personal finance, and all-around financial wellness. Here is your host, Yolanda Rose.
Thank you for joining me on another episode of the Wealth Nation podcast. I am Yolanda Rose. I am a property investor, a wealth advisor, a financial advisor, and it is my goal on this podcast and any other content that I put out on social media is to give you the tips, strategies that you need to manage your money well and to build generational wealth. If you're listening to us for the very first time, please consider subscribing to this podcast. Also link up with us on our various social media platforms. It's Financially Fabulous Females. We're online, Facebook, LinkedIn, Twitter, TikTok, Instagram. Connect with us, say hello, and let us know what you think about this podcast. The Wealth Nation podcast is sponsored by Audible. Audible is a seller and producer of spoken audio entertainment, information, and educational programming on the internet. Audible sells digital audiobooks, radio and TV programs, and audio versions of magazines and newspapers. For a 30-day free trial of Audible, go to www.financiallyfabulousfemales.com/audible. Since we're talking property today, I wanted to share with you a financial term that I use when evaluating investment property, and it's called the cap rate or capitalization rate in full. This is a number or a ratio that I look at to basically give me an idea if this property is worth exploring further. So it's just a quick comparison to show whether there's any value in the investment opportunity presented. So you calculate the cap rate by dividing the operating income minus the current market value. So the operating income are your rental, or if you get any other income from the expected property, and you minus things like expenses incurred in managing the property, rates, levies, insurance, and other maintenance costs that could be involved. So when you minus the gross income minus the expenses, you're going to get the net operating income. And you're going to divide that by the current market value. That's the present day value of the property. So that would give you a percentage. So if you had R1 million to invest and you're considering investing in either investment property or maybe something else, some kind of paper assets that's offering you a 3% annual interest rate, you're looking for an investment between the two. You can only purchase one. So let's say you'll be able to get 90,000 Rand a year for this investment property, and you have to pay around 20,000 in maintenance costs and rates. So this leaves you with a net operating investment of 70,000 Rands. So assuming during that first year, the property value remains steady at 1 million, the cap rate will be calculated as the net operating income of 70,000 divided by the property value of 1 million Rands. That will give you a return of 7% from this property for that year, which is a far better return than you would get in investing in a paper asset with a 3% interest. All right. And with factoring inflation, let's say if inflation is at 4%, that brings your property investment return to around 3% and your regular paper asset return to a -1. So it's just a ballpark estimate that you quickly gauge in your head to see if it's worth your time to investigate any further. Then there's all the various other things to consider with the property rental, like the quality of the tenants, are they going to pay if they suddenly move out, and all of those dynamics. But this is just one figure that you can quickly calculate in your head to see if this investment property is worth or warrants any further investigation or attention on your part. So that is the capitalization rate.
Raising financially savvy children involves teaching them a variety of skills, from budgeting to planning to earning and saving. Besides giving them an understanding of the value of a rand, it prepares them for real-world finances. Financial literacy is a vital skill, and it is never too early to teach your kids about money. Many parents wonder how they can teach their kids about money and where to find age-appropriate resources. You can now purchase the Financial Literacy for Kids workbook, which is aimed at primary school kids. It's now available at www.financiallyfabulousfemales.com. This workbook provides you with 12 lessons, activities, lesson plans, discussion points, and quizzes that you can use to test your kids' knowledge. Shop now at www.financiallyfabulousfemales.com.
Like what you hear so far? Make sure you never miss a show by subscribing on Apple Podcasts, Spotify, or Tuned In. Now back to the show.
Everybody's keen on becoming a property investor since interest rates are at an all-time low. However, not everybody fits the stringent bank criteria that is required to get a mortgage bond in South Africa. But there are other ways of being involved in the property industry, of investing in property. I want you to check out this week's YouTube video that releases this Thursday at 8 o'clock on our YouTube page, Financially Fabulous Females. Go and check it out. I'm going to give you some additional beginner or entry-level property investment strategies and explaining things in a lot more detail. So check out that video on Thursday evening. But now I'm going to give you two strategies, additional strategies that you can use to get started. Firstly, there's something called a real estate investment trust. Now, I have spoken about it a while ago on the podcast, and I'm going to go to the clip that basically gives you a broad overview about real estate investment trusts.
But there are easier ways for you to invest in rental property or any property in that matter without being actively involved in the investment. And one way you can do that is through a real estate investment trust. And they're becoming more popular in South Africa among investors that are looking to diversify their portfolios, as it gives them access to the property market both locally and globally as well. So you have the benefit of entering the global property market from as little as 500 Rand a month through a REIT. So today we're going to break down a REIT, what it's about, and the pros and cons of it. So when you buy shares in a REIT, you own shares in a company that owns and operates real estate investments. So you can obtain exposure both locally and internationally through a REIT without actually buying a rental property or having your name on that title deed. So you don't have that kind of risk involved. You don't have to put that upfront money into buying the property itself. You own shares in this company that owns the property. Now, in South Africa, a REIT must be listed on the Johannesburg Stock Exchange, and there's a whole set of rules and laws that a REIT needs to follow. So in this case, it makes perfect sense for a small investor. So you invest in a REIT, small amounts, it's very affordable, and you buy shares in the company instead of an entire property, so you're not carrying that risk. So it cuts out a lot of the transaction costs of investing in fixed property, like your bond cost, your transfer duties, all of the legal regulation from the banks and the maintenance costs, commissions and all of that. All of that is gone when you invest in a REIT. Now, REITs are structured, they're very low risk investments, and they have clearly defined investment strategies specifically designed to mitigate the risk and make the investment environment a lot more value for the investor. Most South African REITs are very diversified. Like you find a REIT investing in office blocks, warehouses, factories, hotels, a block of flats. And these a lot of the times, these properties are spread across different cities, different provinces. So your hand reaches that far as an investor. So the total return that a REIT creates for investors comes from both capital growth of the actual value of the property and from the regular dividends which the REIT pays out in the form of a portion of their profits. And those profits usually keep up with the pace of inflation because remember those leases, they're renewable annually to those tenants. Now, REITs are highly regulated in South Africa, and South African REITs have to pay at least 75% of their taxable earnings to investors every year. So it gives you, as an investor, certainty that there will be an income distributed as opposed to owning shares in a company. Now, there's always a place in your portfolio for shares, but at the end of the day, it's the board that will decide how much goes to the investor. They'll retain 50% and 50% of the profits get paid as dividends. I mean, that's just an example, but really it's up to the board. Whereas with a REIT, minimum 75% has to go to the shareholders. In a REIT, the growth happens in the form of rental income from its property assets, which escalate due to the leasing process. But these leases make it very easy to predict the future earnings for investors and provide relatively stable income stream, which usually goes up due to the rental process. One thing that as a REIT investor you have to consider is the tax consequences that you are liable for as a REIT investor. So payments to shareholders of REITs generally happen through payment of annual dividends. And these dividends are treated differently from normal dividends that you would get from holding shares in a company. REITs are very different to other share-listed companies on the JSE. So while dividends from a REIT is not subject to the 20% dividends withholding tax, it is not exempt from tax like a normal dividend. So this means that the full amount of the dividend received from the REIT will be subject to tax in the hands of the taxpayer. So, for example, let's say you receive a 40,000 Rand dividend from a REIT. The tax payable on that will be depending on your tax bracket. So if you're on a 26% tax bracket, you are liable to pay 10,400 Rand. If you're on a 39% tax bracket, you're liable to pay 15,600 Rand. And if you're on a 45% tax bracket, so of that 40,000 you receive, 18,000 Rand goes to SARS. So if you earn a 40,000 Rand dividend from a REIT, you don't have to receive the dividend for it to be taxed. So if you tell the company, you know what, keep that 40,000, let me reinvest, you are still liable for tax and you're taxed within your tax bracket. This tax will for most individuals be paid when you file your annual tax return and you have to declare the REIT dividend. And there's a specific code for it if you're familiar with the tax codes in South Africa. So if the dividend that you receive from a REIT is more than 30,000 Rand for a tax year, you should also register for provisional tax. So in terms of taxation, the dividend you receive from a REIT is as much as the same profit you would receive as you are owning a property, a rental property for that matter. So the full amount of the profit, the taxable income from the rental property, is included with your personal income tax. So this is same with the REIT dividend. I mean, not knowing the tax implications of a REIT investment could result in a nasty shock from SARS. So be aware that it is also possible for the share price of your REIT to increase in value. And in such instance, the disposable of your shares will result in capital gains tax, which is uniform throughout the shareholding in South Africa. So many South Africans choose to invest in REITs through a unit trust platform. So you're not really holding shares in the REITs here, but you're getting the benefits of the REIT. So a unit holder may receive dividend income, and in that dividend income, your 20% withholding tax is paid for you. You will get interest income included with other interest income and taxed, or be subject to capital gains taxed on the disposable of the unit trust, the real estate unit trust. So that's one of the benefits of unit trust is that you only pay tax when you sell, not the profits made within the investment period. Okay, so that's my take on REITs. It's a truly a legitimate low-cost investment in which you can hold property in South Africa, enjoy the benefits of holding prime property in South Africa and globally, and without actually shelling out huge sums of money. But these kind of investments, they're long-term investments. You want to be in it for at least 5 to 10 years.
So as you can hear, this is a nice entry-level way for you to get your feet wet in the property investment industry without really getting your hands dirty in terms of actually owning property, having your name on the title, and being actively involved in the management, while getting 75% of the rental income of obviously what you invested. And you're not limited to local. You can expand globally, US markets, international markets, European markets, if you have the right financial advisor to advise you on the various funds that are available to you in South Africa. The second way to get involved with property investments, a nice strategy for you to use, is to invest in equity into property developers. And one that I feel that is doing really, really well right now is Baldwin Estates. Now, you can buy shares in a company like Baldwin on the Johannesburg Stock Exchange, and they're trading relatively low. So as Baldwin increases, they're gaining more properties, their share prices increase. That's how you make a profit. All right. There are capital gains involved as well when you do sell. But this is one way for you to enter this market, understand property development, because when you own these shares, you want to know what's happening in Baldwin. You want to know what they're developing next, how are they expanding. And when you see how this company is moving, it will give you ideas and inspire you to start your own thing on the side. So those are just two ways on how you can get started in the property market. It's two small ways, minimum entry ways, doesn't take a huge amount of money, but it exposes you to the different fields that are available in property investment. It's not just about buying and physically holding a house or flat or any kind of investment property. There are other options, and don't feel discouraged, because it's really tricky to get a bond from the banks. Interest rates are low, yes, we know, but the banks are being tighter because the economy is tighter. And even people are more prone to losing jobs. And you don't want to be in the situation where you can barely make payments, something happens to your job, you don't have that kind of cash flow to maintain the property, and then you're stuck. So this is a nice risk-free way. And the nice thing about the REITs also is that you can hold them on a tax-free platform and not pay any taxes on them while still making money in the real estate environment. All right, that's it for me on this episode of the Wealth Nation podcast. I'll speak to you next week. And it's the Christmas season. We're in the second wave. Please take care, be careful, and be cautious, but don't live in fear. All right, I'll talk to you soon.
Thanks for tuning in. Make sure to visit our website at www.financiallyfabulousfemales.com and sign up for our free investment masterclass.